If you have a stock portfolio, a 401k, or really anything denominated in US dollars, what I'm about to show you has cost people everything repeatedly throughout history. And it's happening again. The Roman Empire. Around the 3rd century, the currency died. The British Empire's currency dominance died in the 1940s. The Weimar Republic's currency died in 1923. The Soviet Union's currency died in 1991. Different cultures, different centuries, different triggers, but the same ending. And here's the line I want you to sit with. We are now living in a world where U.S. interest costs have surged to the point where they can rival and in certain fiscal snapshots even exceed what the U.S. spends on the entire military. Just let that sink in. Not the debt itself, the interest, the service cost, the carry cost of the system. And by the end of this video, my goal is simple. You'll understand exactly why currencies fail, how often this pattern repeats, and most importantly, the framework I use to position my portfolio so that whether I'm right or wrong on timing, I come out okay. This isn't doom and gloom. This is pattern recognition. I'm going to show you a pattern that's repeated for 2,000 years, and I'll explain how I'm positioning my own money because of it. And if you want to know I'm actually investing through all of this, that's exactly what I share inside the 100X Club, including exclusive weekly videos showing the exact stocks I'm buying and my full millionaire blueprint so you can build a portfolio like an owner, not a saver. If you want that, it's in the pinned comment. All right, let's start with Rome. Why? Because Rome is the cleanest case study you'll ever see for how a currency dies in slow motion. In 64 AD, Emperor Nero had a problem. A massive fire tore through Rome, he had wars to fund, he had rebuilding to pay for. And, like every politician since the beginning of time, he enjoyed spending money he didn't have. Now, Nero didn't have a printing press, but he had the ancient equivalent. He could debase the coinage. Rome's silver coin, the denarius, was supposed to be, silver. Historically, it was close to pure, roughly 90–95% silver in earlier periods depending on the exact issue and era. That purity was the trust. That trust was the money. So, Nero does what desperate governments always do. He says, let's shave it a little. Take it from about 95% down to 90%. No one's going to notice. And maybe people didn't notice at first. That's the key. Currency death doesn't begin with panic. It begins with small, reasonable decisions that feel invisible in the moment. But here's what always happens. Once you prove you can get away with it once, the next guy gets inspired, and the next guy, and the next. Fast forward a couple centuries into the 3rd century, roughly the crisis period around 260 AD, and the silver content had been crushed. Not 90%. Not 50%. Single digits, 5%, sometimes lower. Some coins from late in that spiral are basically copper with a thin silver wash like makeup on a dyeing system. What happens next is not mysterious. Hyperinflation, loss of trust, economic breakdown, soldiers demanding payment in goods instead of coin because the coin doesn't mean anything anymore. And when the army stops trusting the money, the state is done. The empire fractures. Now, here's the part that should make your skin crawl because it sounds familiar. If you asked any emperor during that slide, what's the value of this coin, they would have told you it's worth exactly what it's always been worth. It's the denarius. It's official. It's money. It's fine. That's how this always works. The official story is stability. The lived reality is your money buys less. Now, let's bring this home to the US dollar because that's where most of us store most of our time and labor. Have you noticed prices rising faster than your paycheck? Have you noticed that what your parents paid for a house now sounds like a fairy tale? Have you noticed your savings account might earn 4% if you're lucky, but the stuff you actually buy feels like it's climbing 7%, 8%, 10% a year, and yet nobody calls it a crisis? On the surface, you get the reassuring language. Inflation is trending toward target. It's transitory. We're data-dependent. Translation. We're going to do what we have to do, and we'd prefer you not freak out while we do it. And that feeling you have, that disconnect, that sense that the headlines say one thing while real life feels more expensive, that's not irrational. It's historically consistent. Now, when people hear currency failure, they imagine a movie. Mad Max, dollar bills as wallpaper, people trading canned food in the streets. That's not usually how it happens. Currencies don't typically vanish overnight. They degrade slowly, quietly over years, sometimes decades. You still go to work, you still get paid, you still swipe your card, the money still works. But there's a catch. It buys less. Let me put numbers on that. Since 1913, the year the Federal Reserve was created, the U.S. dollar has lost the vast majority of its purchasing power. You'll often see estimates around the mid to high 90% range over that full period, depending on the index and exact measurement. The broad point is not controversial. A dollar buys a small fraction of what it used to. What your grandparents bought for $1 can cost many multiples of that today. And, by the way, that's not a conspiracy theory. That's the government's own inflation data. You can look it up. You don't need to trust me. So when I say currency degradation, I'm not saying the dollar becomes a zombie tomorrow. I'm saying over time your stored labor melts, and if you don't build a portfolio that's structured for that reality, you get punished quietly. And this pattern, again, is not new. The people living through it always think their currency is different. Their government is smarter. Their situation is special. It never is. One of my mentors gave me a rule I've never forgotten. When someone says, "This time is different," your default assumption should be, "No, it isn't." Let's talk about Britain for a second. The pound sterling used to be the currency of currencies. It was the prestige money. When Brits traveled, they felt like everything was cheap because the pound carried weight. And then history happened. Reserve currency status shifted. The empire shrank. Debt dynamics changed. Growth slowed. The pound's purchasing power eroded relative to what it once commanded. And here's what everyday people feel. Wages that don't keep up. Living costs that surge. Housing that becomes absurd. And a stock market that can underperform for long stretches. Now, I'm not here to dunk on the UK. I lived there. I like the UK. But it's a clean example of how decline feels in real life. It's not one day where the currency dies. It's 20 years where it quietly stops giving you the life your parents had. Weimar, Germany, is the famous horror story. Workers paid twice a day because money loses value between morning and night. People using wheelbarrows of cash to buy bread. Currency replaced at absurd conversion rates. And yes, the imagery is dramatic. But notice the mechanism. The state breaks trust in the unit of account. Once that's gone, everything else follows. The Soviet Union, different system, different politics, same vulnerability. When the state breaks, the currency breaks. And for ordinary people, what that means is brutal. Lifetime savings wiped, retirement plans vaporized. You can work your entire life and then wake up and realize the numbers in your account no longer translate to real life. So why does this keep happening? Why hasn't any government across millennia been able to resist this temptation? Because the incentives are wrong. Put yourself in a politician's shoes. You have two paths. Path 1, you're responsible. You cut spending, you raise taxes, you tell the truth, you do the hard thing, and you get annihilated at the next election by someone promising free stuff. Path 2, you fund everything. You spend, you subsidize, you bail out, you send checks, you make people feel good right now, and the consequences land later after you're out of office, retired or dead, popular or unemployed. That's the selection mechanism, and it's why history repeats. Now layer on top of that the modern debt dynamic. When the debt stock gets big enough, the interest becomes a machine. And once you're in the machine wants to grow. Here's the uncomfortable reality. If you have massive debt, and you can't politically cut spending enough, and you can't politically raise taxes enough, and you can't politically default, what's the acceptable option? Financial repression and devaluation. You let inflation do the dirty work. You pay yesterday's promises with tomorrow's purchasing power. And this is where people say, well, just tax the rich. Okay? Even if you confiscated a huge amount tomorrow, you don't solve a compounding system problem with a one-time grab. And once taxes cross certain thresholds, capital moves. It doesn't complain. It relocates. That's not moral commentary. That's behavioral reality. So the printing press becomes the quiet solution. And when you print more units of something, each unit is worth less. That's not ideology. That's arithmetic. Debt is denominated in dollars. If dollars lose value, the real burden of past debt falls. It's effectively a hidden restructuring paid for by anyone holding cash, fixed income without protection, or wages that lag inflation. And that's why it feels silent. There's no tax bill in the mail that says, "Congratulations, we just reduced your purchasing power by 6%. It just happens. You notice it at the grocery store, at the rent renewal, when insurance jumps, when healthcare jumps, when your raise doesn't change your life at all. Now, people will say, America is different, and I get it. I really do. We have the largest economy, deep capital markets, massive innovation, the world's strongest military, the reserve currency, Silicon Valley, productivity, all of it. But ask yourself something simple. Was Rome not the most powerful empire of its age? Was Britain not the dominant global power of its age? Reserve currency status doesn't prevent degradation. It delays it. It buys time. It doesn't buy immortality. There's a concept in economic history. Reserve currencies have a lifespan. People debate the exact number depending on the data set and definitions, but the broader idea holds dominance rotates. The US dollar has been at the center for a long time now. That does not mean collapse tomorrow. It means we should stop assuming permanence. Think of it like this. You're looking at yogurt in your fridge. The date says it expired last week. Does that mean you instantly die if you eat it? No. But it does mean you are officially in the zone where you should stop acting like the label guarantees safety. Now, here's where things get interesting, because you don't have to guess what the system insiders believe. Look at what central banks do. Not what they say, what they do. Central banks have been buying gold in large quantities in recent years, multiple years in a row of very heavy purchases. Poland, China, Turkey, various countries increasing reserves. That trend matters because central banks are not Reddit. They're not vibes, they're not memes, they are institutional actors hedging the monetary system itself and ask the obvious question. If everything is fine, why are the people who manage currencies buying the asset that sits outside currencies? Because they understand the cycle. So where are we in that cycle? What are the signals? What should you watch for? So you're not the person who wakes up 10 years from now wondering why life got harder, even though you did everything right. Here are a few signals I personally track. First, central banks changing behavior. Large, persistent gold accumulation quietly, methodically, not a tweet, not a headline behavior. Second, interest expense becoming a dominant budget item. When interest costs start competing with core state functions, that tells you the debt stock is no longer a background number. It's the engine. Third, listen to the language around growth. Notice how everything requires strong GDP. Notice how a lot of reported strength can be driven by government spending, credit expansion, and statistical definitions that don't always match lived reality. Consumers healthy while revolving credit surges. Job market strong while people stack gigs. Inflation cooling while essentials still feel hot. And fourth, and this is the one I care about most, watch what wealthy individuals and institutions actually own. Follow the money. Everything else is opinion. What do the wealthy own? They own productive assets. They own businesses. They own real estate. They own infrastructure. They own farmland. They own things that can reprick. They own assets with cash flows that can rise. They don't save their way to safety. They own their way to safety. Now, I want to talk about gold and silver because this always turns into a weird emotional conversation. I'm not a gold ideologue. I'm not trying to go back to the gold standard. I'm not telling you gold is magical. I'm a pattern guy. And the pattern is when trust in paper gets stressed, gold re-enters the chat. Not because it's perfect, because it has one property paper money can't replicate. No counterparty risk. What does that mean? If you hold dollars, you are trusting the issuer. You are trusting policy. You are trusting restraint. If you hold a physical metal, you're not trusting someone's promise. You're trusting the fact that it exists. Now, yes, gold doesn't produce cash flow. You store it. You insure it. It just sits there. So why does it matter? Because in monetary stress, insurance matters. Gold and silver to me are insurance, not a religion, and not the whole portfolio. I'm not trying to time the gold market. I'm not waiting for gold to moon. I hold some because history shows that in currency transitions, people who had assets outside the system generally did better than people who had only claims inside the system. And, by the way, the people who lose in these slow erosions are rarely the gamblers. It's usually the disciplined savers. That's the tragedy. If you're diligently saving cash in a bank account, you can be losing purchasing power every year. If your account yields 4% and your real-life inflation is higher, you're falling behind even though you're doing the responsible thing. If you're a retiree living on fixed income, or a pension, or Social Security adjustments that lag the real cost of living, you get squeezed, not instantly, gradually, but over a decade. That squeeze becomes your life. And then you get the people on the sidelines saying, "I'll invest when things calm down," or "I'm waiting for a better entry." And every month they wait is another month where their currency loses a little more real value. Cash melts like an ice cube. It just melts slowly enough that most people don't scream. This is why currency crises don't need headlines. The damage is cumulative. It's compounding. It's the slow transfer of wealth from people holding paper claims to people holding real assets. And here's the good news. Every currency transition in history created winners. It wasn't fun, it wasn't fair, but it's true. So, who tends to do well? Owners. People who own businesses with pricing power. Let's make that simple. If you own the only electricity utility in a region and costs rise, can you raise prices? Yes. Will people stop using electricity? No. That's pricing power. If you own a mission-critical platform, cloud infrastructure, payment rails, enterprise software, can you raise prices 5% or 10% and keep customers? Often yes, because switching costs are high and the service is embedded. Now compare that to a commodity business with no differentiation. 2 identical gas stations across the street. One raises prices, customers cross the road. That's low pricing power. If you want inflation resilience, you want ownership in things that can reprick. Second, real estate. It's called real because it exists. You can touch it, live in it, rent it, use it. And over long periods, real estate tends to reprick with inflation because it sits at the intersection of scarcity, utility, and replacement cost. Third, commodities and metals. Again, not as a personality trait, as a portfolio function. Insurance. Now, what's the worst reflex people have when they get scared? They run to cash. They think cash is safety. But cash is a claim on a system that can create infinite claims. Cash is an IOU issued by an entity that can issue more IUS. If your friend borrows $5 from you and hands you an IOU, fine. If your friend hands out IOUs to the entire school every day, eventually you realize your IOU isn't special. That's what money printing is. Your dollar claim is less unique over time. So, the saving class gets crushed. The owning class adapts. And now we get to the part that actually matters. What do you do with this information without becoming a doomer? Without pretending you can time a collapse? And without doing something stupid out of fear, here are the principles I use. First, no single bets. Don't put everything in gold. Don't put everything in stocks. Don't put everything in real estate. You can be wrong. You can be early. You can be right on direction and wrong on timing. Diversification isn't about maximizing returns. It's about surviving when you're wrong. Second, own assets, not piles of cash. You need an emergency fund. Fine. You need liquidity for life. Fine. But structurally, if you're sitting on large idle cash for years, you are voluntarily accepting purchasing power decay. So the core becomes businesses with pricing power, quality equities, some real estate exposure if it makes sense for your situation, some insurance assets like gold and silver. The exact percentages depend on your age, income stability, risk tolerance, and goals, but the framework stays consistent. Third, insurance, gold and silver, maybe Bitcoin, depending on your beliefs and risk appetite. Bitcoin is its own debate. It's volatile. It has drawdowns, and it's not the same thing as gold, but as a non-S sovereign asset with a fixed issuance schedule. It plays a role for some people as part of an outside-the-system basket. If that's you, fine. Just size it like something that can get cut in half without ruining your life. Fourth, humility. This is where most people blow themselves up. They want certainty. They want the date. They want the headline. They want the dramatic moment. The market doesn't owe you drama. My goal isn't to predict the exact moment of a reset. My goal is to structure my portfolio so that across a wide range of outcomes, I'm okay. That's what serious investors actually do. They don't need to be prophets. They need to be survivors. So, what do I actually do practically? I put money to work consistently. I don't wait for perfect. I don't pretend I can nail the bottom. I look for repeatable patterns, valuation dislocations, quality assets at reasonable prices, businesses with real cash flows, pricing power, strong balance sheets, and long runways. And I build positions methodically with risk management so one bad scenario doesn't erase me, because I understand one thing. Cash sitting idle in a bank account is a guaranteed way to get slowly poorer over long periods if inflation runs above your yield. And here's something that surprises people when I say it. I'm not bearish on the stock market just because inflation exists. In many inflationary environments, stocks, especially strong businesses, can be one of the best places to be because revenues and profits can reprick. If more money is sloshing around the system, asset prices can inflate. That's not optimism, that's mechanics. So the point isn't fear. The point is structure. The Roman Empire didn't collapse the day Nero shaved silver off a coin. It took centuries. Life went on. People adapted. Britain didn't vanish when reserve currency status shifted. The country still exists. It's just different. What I'm describing isn't apocalypse. It's transition, gradual change, a reordering, and the people who understand the transition tend to do better than the people who insist nothing is happening until the damage is already done. Because the most dangerous part of this pattern is that it doesn't feel urgent. There are no sirens, no currency collapse, breaking news banner for years and years. Just groceries up a little, rent up a little, insurance up a little, taxes up a little, wages lagging a little, and then one day you look back and realize your entire working life got taxed by inflation. That's why doing nothing is a decision. Every year you sit entirely in paper claims without a plan. You're making a bet whether you admit it or not. Or so if you take nothing else from this. Stop waiting for a perfect signal. The pattern is the signal. Debt compounding, interest burdens rising, central banks hedging with gold, asset owners preserving purchasing power while savers get squeezed. If you want to take this to the next step and actually learn how we follow the money because the big money is following this, join the 100X Club. Exclusive weekly videos showing the exact stocks I'm buying and Millionaire Blueprint so you can build long-term wealth. It's in the pinned comment. And if this video helped you see the pattern more clearly, share the video with a friend.